introduction to stocks. We will be going over what stocks are, what are they for, why they exist, and then in the end, in the second half of the presentation, we will go over the basic fundamental analysis of stocks, which I think some of you may already know, but in the very end, I'll go over beta. Does anyone here know what beta is for? Beta? Okay, that's okay. We'll learn about beta in the end. We will be doing a bit of math. It's okay if you don't understand the math behind it. I don't completely either, but yeah, that's it. So Philip will start us off.
Yeah, okay.
Introduction to stocks.
Yeah. So our lesson overview is basically why you should know about them. What are stocks? Are stocks a thing in the first place? Why do companies want to issue their stocks to new investors? And then at the end, we're going to be doing fundamental analysis. Okay, so why you should need to know about them? Well, first of all, stocks can be an appreciating asset to an investor. And stocks can also be a valuable portion for your investment portfolio. And your investment portfolio can be comprised of real estate, bonds, stocks, commodities, basically assets that appreciate over time. And then it helps you battle inflation because the market moves at a higher rate than inflation typically does on average. Inflation usually only rises 2 to 3% annually. And then possible tax benefits that can come in capital gains tax, where you only get taxed on half the amount you actually make, at least in BC. It varies per region, however. Then what are stocks? Well, essentially stocks are a share of a corporation that represent the fractional ownership. Say if you own 10% of the outstanding shares, then you own 10% of the company itself. When an individual owns a share of a company, they own a portion of the business itself. Stocks have the potential to be an appreciating asset, typically depending on the company's performance. However, it can also be the perception of the company. Some companies also pay dividends, which are basically quarterly payments of profits to investors, and it can be a great source of passive income for some. So stock exchanges, what are they? Well, stock exchanges are essentially where individuals meet to buy or sell shares. It's essentially a meeting place. Some popular ones in North America, in New York Stock Exchange, Toronto Stock Exchange, Montreal Stock Exchange, and the NASDAQ. So a little bit of history on stock exchanges.
Here you are. Can you grab a seat, please?
Okay, so basically 1980s and before, people actually had to physically go into the exchange to make trades. And that's why in this photo you see so many people gathered around on Wall Street, right in front of the New York Stock Exchange.
That's Great Depression, isn't it?
It's some photo from the past.
Yeah.
Yeah, the exchange. Yeah. And then 1980s come around, and that's when you start seeing phone brokerages, where essentially people relay information onto the exchange via phone, and that caused less people to actually need to be at the exchange itself to exchange the trade.
Back then you would just call your broker, right? Have you guys seen the movies where, let's say you're on the trading floor, right, and then a bunch of you have like papers on their hands and they're like yelling at each other? That's kind of what came after the in-person exchanges, right? You would call your broker, and then after you go to the brokerage and get your shares. So what they do, it's like they would yell at each other, and then they would make like say hand signals like buy and sell. But now it's different.
Yeah. So 1990s and present, we come on to the digital age where you make majority of your trades online, and that just gets sent straight to the exchange, which requires very few people. And then why are stocks a thing? Well, many companies enter an exchange in order to raise capital to grow. Raising capital could mean that the company can also avoid going into that and not having that as a liability. However, that can also be leverage, and by leverage, I mean it can magnify your returns or losses. For example, can you guys see this first of all?
We can move it up.
Yeah.
Here. Move the other side.
Okay, well if you guys can't see, there's $100 here. And this is in situation 1 where you don't borrow any money, so you're not in debt. And say you make a 10% return, then you get $10 profit, right? And then in situation 2, say you borrow $50 plus the additional 100 that you had in situation 1. However, the $50 you borrowed is at 2% interest, so essentially meaning you have to pay back $51 at the end, right? And then if you make that 10% return, it's gonna give you $165 without paying it back yet. And then you have to pay back that debt, 51, which then gives you $114 compared to 110. So it magnified your returns by about $4, right? Because in situation 1 you were making $10. Now in situation 2 you're making 14, right? However, if you lose that money, say that 150 turns into $135, which is the 10% loss, and then you also have to pay back your debt, then that only leaves you with $84 and you lost $16 compared to $10 what you would have lost in situation 1 without borrowing anything and just having $100.
Yeah, so that's overview on leverage.
Yeah.
You guys are leveraged. Were you aware of that?
Yeah.
Okay. If you guys didn't know, they accidentally borrowed $400,000. So. Alright, yeah. No, it's fine. I need it later.
Oh, okay. So first of all, this slide covers what drives the price. It can be in the form of company news. For example, if you invest in some sort of gold mine and there's news that they stumbled upon a large supply of gold, the value is of course going to rise because investors have a lot more confidence in the company's growth. And then improving growth prospects, this can come in the form of earnings calls. If the company is doing better than it was last year and it's continuing an upward trend, that can mean an increase in value for the company. And then management changes as well. Say a CEO who has a very poor track record for the last 5 years takes on a new company, then investors are going to lose some confidence to invest because the company's management is seen as poor. And then changes in the economy that can come in the form of recessions. For example, Walmart would suffer recessions as less people have money to actually consume the products, which would drive the sales to go down. And then investor sentiment. So basically, is it a bull or a bear market? So basically that means bull is there's a lot of confidence, stocks are rising in that industry. Bear means the opposite, investors are scared to invest and there's not as much confidence, which will drive the price to go down. And then essentially what really makes up the price of the stock is, are more people buying or selling the share? It's a simple supply and demand there for price.
Here, I want to talk about some things here. Do you guys know why it's called a bear or bull market? Yes.
Because a bull like tax upwards and a bear like tax downwards.
Yes, that's why. Do you know the definition for a bear market?
So basically, it's a period where investors are not confident in the market and expect it to go down due to.
There's a specific definition. Do you know it? We were in it in March. We were in a bear market in March.
A stock market crash.
Sure. So bear market official definition, it's 20% decline from its all-time peak. So if you're on an upward trend, right, and you drop by 20%, you're officially in a bear market. The other thing I want to mention here, it's management changes. Do you guys here know one very big management change in a big company in 2014? This happened within our lifetimes. It's okay if you don't. Just guess random company names then. Bob. YouTube, it's not YouTube, it's owned by Google, I believe. So, but no.
No.
No, I was, yes.
Was it AMD?
No. The example I want to talk about was Microsoft. In 2014, there was a big management change from Steve Ballmer, which is a past CEO, to a new guy called Satya Nadella, right? Basically, Microsoft, if you guys want to pull out your phone right now, that would help, and then search up Microsoft stock. If you have iPhone, it should be in the stock app. Microsoft is MFST. If you don't, I think you have to go on Google. And then search up the stock price chart and then go for either 10 years or max. So you want to see 2000 to 2000 and to now. 2000 to now. You want to pull out the graph. Are you guys on it? All right. So Bill Gates had to leave Microsoft in 2000 over an antitrust lawsuit. That basically means they were getting sued for monopoly powers. So Steve Ballmer came in, and if you can see, basically what happens is, in 2001, there's a big crash. Do you guys see that? The big decline. That's called the dot-com bubble, which we will cover later. From after the dot-com crash to 2014, you can basically say the stock is flat. There's literally no change in price, which is kind of bad for 14 years, right? And investors were just tired of the Steve Ballmer guy. So when Steve Ballmer left, this guy actually made $1 billion by leaving the company because his stock went up 10%. And this is what we want to talk about management changes, right? Simply by this guy leaving, the company went up 10%. And yeah, that's what we meant by management changes. And second question I have is, do you guys know what determines the price of the stock? I'm going to pick on you. Ryan.
Like how much people buy or sell the stock and the company value.
You mean, can you rephrase that?
Like
Supply demand?
depends on what the investors think of the company and how much they're buying and how much they're selling.
So yeah, that was the answer I was looking for. I was expecting more wrong answers. Basically, what determines the stock's price? It's the highest bid and the lowest ask. There's no like magic formula, right? One great example right now is Tesla, which I know some of you are owning. I saw it on some of your portfolios. Tesla, it's a controversial company, their stock. Currently, they're trading at $600 a share, right? But there's two banks on Wall Street, Goldman Sachs and JP Morgan, right? Both two of the biggest investment banks in the world. Very smart people, obviously. But Goldman Sachs looks at Tesla and says, Tesla is worth $780 a share. While JP Morgan comes and looks at Tesla and says it's worth $90 a share. So that just shows that really there's nothing to determine the stock's price besides how much you think it's worth. Is there any questions? All right, next we will go into intro to fundamental analysis. So again, if you can pull your phone, that would be great. I'm sorry. Who has an iPhone here? All right, if you have iPhone, go into the stock market app. We will think Apple stock will be a good example for this. If you can just pull up Apple, the symbol is AAPL. So we'll be going over the basic fundamental analysis today. And this should be what you see on the bottom. Do you guys see it on the bottom? These terms, open, high, low volume, PE, market cap, 52-week high and low, average volume, yield, and EPS. So these are the basic terms when looking at a stock. All right, we'll start with the easiest, open, high, and low. This should be pretty intuitive. Open is just how much the stock started trading at today. So the first trade, that's the open. The high, it's how high it was trading at today, and the low is how low it was trading at today. 52-week high and low just means 1 year, right? So from a year ago to now, what was the highest price and what was the lowest price? Next, it's market capitalization. Market capitalization basically tells you how much a company is worth, right? So, for example, if you have like the example up here, is the stock is worth $10, there's 10 million shares outstanding in the company, and the company will be worth $100 million. So, for market cap, how market cap is determined? Do you guys know how market cap is determined? That's okay. Market cap, it's determined again by the market, right? When a company first goes public, called the IPO, a bank will come in and then they will evaluate this company, right? And they think, okay, well, they'll come up with a fair price for it, and then they'll come up with how many shares. For example, let's say I want to take my company public, right? I'll go to an investment bank. The investment bank will come and look at my company, and they'll say how much they think my company is worth. And then they'll tell me a price to IPO at. So 2 recent IPOs. Do you guys know any 2 recent IPOs? Very big. Airbnb, yes, that's one of them.
Palantir.
Pardon?
Palantir.
Palantir? No, that's more back. Last week. No, DoorDash. So DoorDash and Airbnb were surprising in that on their opening day, right, they both shot up 80 and 100% respectively. So what that means is they went to an investment bank, right? The investment bank says you're worth this amount of money. But then when they went public, the public investors looked at the Airbnb and DoorDash says you're worth more. And that's just market cap. Is there any questions about how market cap works? It's basically just how much the company is worth. How much you think the company is worth. Volume and average volume. Volume is just the amount of shares being traded per day, and the average volume is the amount of shares traded over a period of time. Volume, if you look at volume, I believe, if you look at the stock price, right, underneath, you should see this bar graph. Do you see a bar graph? No? Can you call your phone? You guys do see volume, right? It's abbreviated as VOL,
Yeah.
and the average volume is AVG VOL. I don't think that has volume as an index.
Oh yeah.
Yeah, do you guys not see it? There's like below the years, right? There's that little bar graph. Do you guys see that?
It's in white.
Yeah, that's the volume. And if you look at the 1 year graph, do you see a big peak in volume? No matter where. Do you see a peak? When? For this year, 2020. Okay, well, I'll just tell you then. It's March. Do you guys see the peak in March? How the graph will tend, there's a big spike in March. And that basically means just there's a lot of volume being traded, right? March was kind of like a panic time this year. It was when the lockdowns first started. Investors didn't know what was happening, so they were panic selling, and that just increases volume. Is there any other reason why volume will go up? Any other day? Ryan, take a guess.
Like volatility.
No. Yes and no, but I'm looking for a specific date, for example. Why would volume go up? Yes. Yes, that's it. Earnings report. So, all public companies, right, they need to publish their financials on a quarterly basis, right? And that's called an earnings call. It's typically where either the CEO or the CFO will go on a call, and then they will release their information to the public, right? And there's a lot of trading activity and a lot of price moves on earnings day, because it's basically when they say, hey, this is how much money we make, right? Either they're beating expectations or they're failing expectations, because the way earnings work, it's Wall Street has an expectation for the company, right? They expect them to make this much money. If they do better, then their stock will go up. If they don't, if they fall under the expectation, then their earnings will go down. If you guys are interested in attending earnings calls, they're all public, but you'll have to wake up at like 6 a.m. because you're all in New York. All right, next, PE and EPS. Without looking at it, you want to know here what PE is? Yes, price earnings, and EPS. I think they're both on that chart, right? So your PE and EPS are two ratios that we can use. The price to earnings ratio basically takes the price of a company divided by how much money they're making. It's a way to judge whether the company is overvalued or undervalued. Your EPS is just the earnings per share, like how much each share of stock will make you. So if you want to figure out PE, you take the price of your stock divided by EPS, earnings per share, and you get the price to earnings ratio. And then companies that lose money do not have a PE. So I will do a quick PE example. Are you guys understanding what I'm saying? With PE, for example, let's say company X, right? Let's say company X, Y, Z, it's valued at $100 per share. And the company has 1,000 shares. Let's say they make $1,000. Or let's say they make $5,000, right? Earnings, it's $5,000. What would their EPS be? Kyan, what would their EPS be? Earnings is $5,000.
And then the price is 100, is what you're saying.
Yes.
So then isn't it 100 over 5,000?
No, the EPS will be $5. I'm sorry, it wasn't clear enough. So this is the outstanding shares, right? This is how many shares are in total. The company has 1,000 shares, right? Each share is worth $100. That means the company's market cap will be $100,000. Does that make sense? So the company's valued at $100,000. And then they make $5,000 this year. What would their EPS be? Pardon? Yes, $5. EPS will just be your earnings divided by the amount of shares. What would their PE ratio be then? price to earnings. Yes.
It would be 100 out of 5,000.
You mean 100 over 5,000?
Yeah, because $100 is the price and the earnings is $5,000. Or is it?
You're on the right track, but no, because it's earnings per share,
Oh.
right? You were calculating earnings in general. So what you would do in that scenario is divide 100,000, the total market cap, by the earnings. But in this case, right? So PE, it's just equal to PE is equal to price divided by EPS, and the price is price per share. Do you guys want to take a photo of that? But it should be on the internet. So the PE in this sense will be $100 divided by $5. What will your PE be? Yes.
20.
Pardon?
20.
30?
20.
20.
Yeah.
100 divided by 5 is 20, right? So in this case, your PE will be ratio will be 20. But let's say you have a company, ABC over here, whose stock is valued at $200 per share, right? Earnings, I'll just do EPS. EPS is equal to $5. What would their PE ratio be? Bob, what would their PE ratio be? $200 per share, earnings per share of $5. What would their price to earnings be?
40.
Yes, PE equals 40, right? And now you want to look at it. Which of these companies do you think? Let's say they're both in the same sector, right? Which of these companies are more valued, or overvalued, or more expensive? I want to pick something else. Nagar.
ABC,
ABC. Why?
because the ratio is way higher than the other one.
Yes. So you're paying in this sense, right? What it's saying is you're paying $20 for each dollars of company earnings. But in this sense, you're paying $40 for each dollar of company earnings, right? Now, I want to talk about some shortcomings of PE. Why do you think PE might not be useful? Bob.
This company might not be doing well in the short term, but might have some plans in the long run.
Okay, that's a good one. Yes, that's one of them.
Yeah, it might not do well for today, and you're like, oh look, it's terrible, but they might have some like good plan that's gonna help.
Yes, that's exactly it. That's one of the reasons why so many tech companies have crazy high PEs. Kaya.
Maybe you could say like the opposite, like right now it's doing well, but like soon it's like gonna crash or something.
Can you provide an example?
I don't know much about stocks.
It's okay.
Just a guess.
Yes, Ryan.
An example for that could be like the oil and gas sector, because eventually we will move into renewable energy. So eventually the companies will become less predominant.
Yes, that kind of relates to him. Why PE doesn't only forecast present, not the future, right? And what I wanted to say was PE doesn't even forecast the present. PE, it's backwards looking, right? What you're doing is you're taking the current price divided by the past earnings, right? But stocks are not backward looking. It looks forward. The market reflects what people think of the future, not the past. So this is one of the shortcomings, right? Which is why you see two PEs. One is a trailing PE, which is why you take it and divide it by the past price to earnings. And the one's forward PE, but they use forecast. And the problem with forward PEs, you're forecasting, which it means you're speculating, right? They can be inaccurate. And then I believe I have a question up there. I said, typically good or bad PE varies on the industry, right? A company operating in, for example, a U.S. coal company's average PE will be 7, and a U.S. software company's PE will be 60. Why are software companies having higher PEs than coal companies? Nohei.
Okay.
Yes, that's you.
Uh,
Why do
Well-
software companies have higher? Tech companies, let's just say tech companies. Why do tech companies have higher PE ratios than, say, industrials?
well, I'm guessing because like coal companies are becoming more and more obsolete. We're using more electric stuff, whereas like tech companies are.
No, ignore the coal. Ignore the coal. My bad on the coal. Industrials. Say, industrials. Do you know what industrials are? Steel, copper,
Okay.
things that we use.
Well, I guess tech's a lot more expensive to create rather than just mining for steel or whatever.
Yes, that's one of the reasons. R&D cost. Bob.
Profit margin is less.
Less
The
for
margin
what?
of profit is less.
For what?
In CAD. Is it?
But why would that make their PE higher then? If their profit margin is less, wouldn't that make their PE lower? Kai.
Is like the price of the stock like overvalued as part of it?
Actually, yeah, that's part of it. I think the main reason why do companies have high PE and people still buy them, right? It's because they're expecting for the earnings to grow. So a company with a really high PE, let's say Tesla, right? 1,000 and 1,200. 1,200, right? Crazy high PE ratio, unimaginable. So you're paying $1,200 for each dollar of earnings. But they buy into Tesla because they think something will happen in the future, right? That will make the earnings go up and the PE ratio will come down. And that's it for tech companies. Tech companies can expand a lot faster than a coal company can, right? It's an innovation of technology. They can expand very fast. The second thing is, right now for tech companies, there's kind of this mood of growth at all cost. Do you know who started this kind of movement? Which company started this movement of putting market share before profit? So you're trying to get more customers rather than make money. It's a company that we all use. Yes. Yes, Amazon. Amazon, when they first started, right? They changed the way kind of how raising money worked, right? Amazon would say, okay, they would tell investors to give me your money, right? I wouldn't make any profit for 20 years, but I will capture a large share of the market. And what they're doing, it's basically they're setting prices low, right? We have low prices.
I think these are the right ones.
We have low prices. They have low prices. They're trying to gain customers, right? They have great products, low prices, but they're just trying to gain market share. Do you know any other company that's doing this? Where they're losing money, but they're trying to gain customers? It's a company that you've probably used before too. Nathan, you haven't answered your question. Okay. The answer I was saying was Uber, right? Uber will purposely low charge you. They will lose money to get your customer, to get you to become a customer, and that's kind of explains why PE ratios will be so high for some companies. One is people expect them to grow in the future. Other, it's they're investing right now to make more money in the future. All right, next one, dividend and yield. So a dividend is just profits that are not reinvested, right? Surplus profits that are not reinvested, that are paid out to investors. If you power your phones again, there should be a dividend yield and yield for Apple. So dividend, it's a money that's paid out. It's kind of like bonds. Do you guys know how bonds work? Right, so it's like an interest payment. It's sort of like an interest payment. The company will redistribute their profits to the shareholders, right? And the yield is just the dividend per year divided by the price. So Apple should have a yield of under 1%. Am I right?
0.64.
Yeah. So that means each year you get 0.64% of whatever Apple's trading at 120, 130.
127.37.
All right. 0.64 of $130, right? You will get that much amount of money back each year. They will pay it to you in dividends, and that will be the yield. For example, look at another company called Exxon, XOM. Their yield is 8%, 7? You got to search out the symbol XOM. You guys see it? The yield should be at around 7 to 8%. Right.
8.09.
Okay. And that basically means each year, 8% of the money will come back to investors, right? I have a question for you. Why would a high dividend yield be a red flag? I mean, isn't high dividend yield a good thing? The company is giving you a lot of money back each year. Yes, Cody.
The company's no longer investing into itself, but instead giving it to the shareholders.
Yes, that's one of the reasons. I think Apple had this problem where they had way too much money, right, that they didn't know what to do with. So investors would rather see the company take their profits, reinvest it, and innovate, rather than just paying back to shareholders. That's one of the reasons why a high PE ratio might be alarming. Yes?
It could be a Ponzi scheme.
Ponzi scheme.
Yeah, like it could distribute the dividends that are higher than the earnings.
I can see how that would work, but I don't have. Do you have an example in mind?
No.
Okay. The one I was thinking of why dividend yield is a red flag, there's two reasons. One, the company might not be able to afford it, right? Right now, ExxonMobil has to borrow money to pay their dividend, and that's not a good sign. They're going to debt to pay their dividend. So that's one thing you should be aware of. High dividend yields might mean the company might not be able to afford it. The second thing is, how do dividends grow? What is the fastest way for a yield to grow? Bob, this is math.
What?
What's the fastest way for the yield to grow? Yield. Yield is a dividend divided by the share price, yes.
For the stock price to drop.
Exactly. So there's two ways of increasing, right? It's either the dividend goes up or the stock price drops. But usually it'll be the stock price dropping that causes the yield to go up. Because if the yield goes up, right? I mean, if dividends go up, that means the company is doing well, right? Then their stock price will go up. Then the yield will stay the same. You get more dividends, but your yield percentage will remain the same. So the fastest way for a dividend to go up, it's by the stock price dropping, and that's why it's a red flag. All right, next up, math time. We have beta. How are we doing on time?
I think you guys are over, to tell you the truth. I think next block has already started.
Really?
Yeah, 11:15.
Yeah, we're 5 minutes over. I think whatever you're about to start is gonna wait for the next meeting.
Okay, sure.
Because I'm imagining you guys have afternoon blocks.
We don't have blocks, right?
We
It's Wednesday.
no.
Oh, it's Wednesday. Okay, well then it's okay if you guys run a little late. How much longer do you figure you're gonna be?
Probably 10, 15 minutes. Is that
Yeah, I think then it's okay for you guys. I forgot Wednesday. No,
Is that okay with you guys? Is there any questions right now before we go into beta? Because beta, it's a bit hard. Any questions about anything we've covered so far? All right, cool. We're good. So beta, represented by the Greek letter. Does anyone know what beta is to start with? Well, if you have an iPhone, you can look at beta. It's part of the fundamental analysis. Beta, and the beta formula. We'll start beta. So, a brief overview. Do you guys know what volatility is? Volatility. Yes.
The stock trades up and down very rapidly. It's not stable.
Yes, shaking. It's volatile, sorry. Means that it is having a lot of movements, right? It's going up, down a lot. And beta basically measures two things. One, it measures correlation. The other, it measures volatility, right? So, this is the formula for beta. You do not need to understand it, but if you want to take a picture of it, you can. Basically what it does is it takes the covariance of the return of your investment, the investment you're looking at, against the investment of the market, divided by the variance of the market. And what that does is covariance, right? It gives you the correlation between their investment in the market. So, what we usually do is, I'm going to erase this, if you guys want to take a picture. Yes?
You should explain what variance is.
Variance, it's return, okay, standard deviation squared.
Yeah, but what does that mean?
How much each data set, so if you look at it, right, it's how much one data set varies from the mean. This kind of like X with the little hat on it just means the mean. And then divided by the term. So how much each point is varying from the mean, right? So high volatile stock will have a higher variance, right? Because they're varying a lot from the mean. They're unstable. So if we draw it up on the graph, I'm going to erase this. Can I erase it now? All right. think it will be easier for me to explain it in the graph than in a formula. Let's say red will be S&P. Do you guys know what S&P is? All right. So for those of you who don't know, S&P, it's a index of 505 American stocks, right? It basically represents the American stock market. All right. So when people say the market's up 10 points, down 10 points, they're usually talking about the S&P. Let's say this is the S&P. I will use a different color. All right, let's say blue. Can you see blue? Blue, it's S&P 500. What would blue's beta be? It's okay if you don't have to know this. Yes.
1.
Yes, blue's beta is 1. Right, and that basically just means because beta compares to asset, right? So whenever you're comparing an asset, the market will be 1. And how volatile your stock will be measured by beta of either 1, meaning it's a market, or greater or less than 1, representing correlation and volatility. If that doesn't make sense right now, that's okay. I'll draw, let's say, a second graph, right? Let's say what would this company's beta be? So when the market's up, say 10%, they're up 20%. When the market's down 10%, they're down 10%. And again and again. Yes? Yes. This, let's say company X, Y, Z, beta is equal to 2. And what that means, it's correlated with the market, right? But it is moving at twice the volatility. And here, I think I can show you on a say can you see the blue line here? This blue line here. Right? So this the green line represents Apple stock, right? This is their stock price over the past 5 years. And the blue line represents S&P, which is the market. So let's say the blue line has a beta of 1, which it does. What would Apple's beta be? You don't have to get the exact number. Let's start with this. Do you think Apple's beta is positive or negative?
Positive.
Why? Yes, Bob.
Because it's growing as the market grows.
Yes, correlation. You can see here, right? You can see all the upward trends and then downward trend here in 2019. I believe that's the trade war between the U.S. and China. And then here, you see this. Do you guys know what this is? 2020 March?
COVID.
Yes, COVID. And again, you can see the volume here. The volume here increases. And so this something like this will have a beta positive, right? Now, do you think Apple's beta is greater or less than 1?
Greater.
Why?
It's more volatile than the S&P 500.
Yeah, it's moving more than the S&P 500, right? During the peaks, it moves more. During the downward trends, it moves more. And that just means it has a beta of positive 1. Now, what would a negative beta looks like? Yes?
It moves less than the market?
No. Yes. No, not you, Bob. Kyan.
Would it be like flat?
Not in this case. Let's say the blue line's market, right? What would a negative beta company look like? Layla? No, Layla, right? Jane.
Janet.
Janet. I'm sorry. I apologize. Pardon? What do you mean by below?
Reflected, like
like that? Because it's inversely correlated with the market. So, do you guys know any examples of companies that will be inversely correlated with the market? Say, market's going up. Why would this company go down? Yes?
Aren't those the companies that bet against the market? I don't know, remember this was examples.
Yes, those will have, you have some of that, SQQQ, right? Its beta is negative 2.3 probably, because it's betting against market. But no, not in this sense, because the company isn't betting against the market, right? We're talking about a short fund, but that's a fund. So typically things like gold, right? Because gold will go up when the market's going down, except it did it in 2020. Basically what that means is because when people are scared, right? They go and buy gold. Gold is something you can hold. They find security in gold, right? And that's something with negative beta. And beta, I think one of you mentioned the negative beta will look like this, but less movement, less volatility. That wouldn't be a negative beta. That would still be a positive beta, but less than 1. Did you find one?
Gold, the example that we put the value
Okay.
of gold on it.
That is okay. And yeah, so last thing before we end, why would negative beta be a good thing? Is anyone having your hands up? Kaya.
Maybe if you're like in a recession or like the stock market crashes, then you can like make money off of that.
You're on the right track, but what's the term for that?
Using negative beta, I don't know.
Again, blue is market, right? Let's just say blue is market. And then I will add purple in here. If this works. Let's say purple, right, has an inverse beta. Still going up, but it's going up the opposite of the market. When the market has a peak, it goes down. When the market has a downward trend, it goes up. But overall, it's still going up. So let's say pink, right? What's pink's beta? What do you guys think pink's beta is? Negative 1. Why would pink be valuable for a portfolio, for you to have a negative beta? Yes?
So it like balances your portfolio, so like you have like a variety of everything, so if one thing
What's
falls,
that
the
called?
others.
There's one term for it. One term. It starts with a D.
Diversity.
No, I didn't. Nagar, what's it called?
Diversification.
Yes, diversification. Right? And what it does is it reduces volatility, right? Now, however, I will state this is theory. In theory, this is how it's supposed to go. These two balance each other out, right? The market goes up, say 10% per year, which is true. The market on average goes up 10% per year, right? But what you're doing is you're diversifying out short-term volatility, and then your return will look something like this, just a straight line up, which is preferable because you have no volatility. And that's where I want to end. Next week, I think we will go into risk management, which some of you are not doing, you guys. We'll talk about 3 types of risk. One, it's idiosyncratic risk. Others, market risk, and then forex risk. Those will be our topic for next week. Is there any other questions before we end? All right, you're free to go then, I guess. Thanks for coming. Yeah. Wait, guys, one thing.
After winter break.
I'll contact you through Teams.
It just taught me
Okay,
to
that was
question
really good.
everything you just
Really good.
Next time, just 4 rounds velocity.
No.